Hey everyone, thanks for joining me for this one. In this video, we're going to go over 5 top Canadian growth stocks that are currently trading on the TSX. But before jumping into it, if you haven't yet, please subscribe to the channel. If you like this type of content, be sure to give this video a thumbs up. It really helps me with the YouTube algorithm. And if you have any thoughts on these Canadian growth stocks or other Canadian growth stocks, would love to hear from you in the comments. Okay, so the first stock we're going to be talking about today, you can see it on the screen right now. It is StorageVault Canada. So before getting into more details about the company, this is a $2.3 billion business. They pay a dividend, but it's not even relevant. It's just a couple fractions of a cent, essentially 0.2% yield. If we look at this company, and we'll go through the numbers on how fast they've been growing, but if we just look at their stock value has grown immensely over the last number of years, going from $2.50 in 2018 up to over $6 right now. It actually hit, I believe, over $7 for a while too, when things were getting really hot in the market and interest rates were really low. So from a stock price valuation standpoint, this company's really been growing their value, but they've also been growing a lot operationally, and that's ultimately what's fed this stock performance. So going into their business a little bit, StorageVault is a storage provider for consumers across Canada. So people go to their locations if they need some extra room, they need to store stuff, they don't have enough storage room at home, whatever their use case may be. They have operations across the country, as you can see by this image here. A lot in Ontario, 122. Out west, they have a good amount too. A bit less out east, but that's just following the population. 238 locations are owned and managed across Canada, and they're actively growing organically, but also through acquisitions. Whenever I go to this company's investor relations page in the last couple of months, they've always picked up a couple more. So they're always looking to acquire and drive scale on their business. As we just look at some of the brands that they play in here, and it's funny that I actually just alluded to that because it looks like just a few days ago they just acquired 3 more locations for $22 million. But I'll put that as an aside. Looking at their brands here, they really do have a ton of different brands across Canada. So if you've seen any of these StorageVault containers, Qubit, Sentinel Storage, Access Storage is the one I'm most familiar with seeing. StorageVault containers as well. I think they have those on people's driveways and stuff. But these are some of the brands that the StorageVault Canada company owns and that you'd own if you own the stock. In terms of some of their performance and investment highlights here, so I think what they're trying to get across here is essentially they are just a very big player in this space. They've made $2 billion in acquisitions since 2015. So they've really grown and built this company off acquisitions, driving synergies, creating value in those that they acquire. And they just have a very strong position in the Canadian market right now. And they continue to talk about how this is a very difficult space to enter. Costs of getting permits and stuff like that to play in this space takes years. So they have a really big moat. Construction costs have also gone up significantly. So them having these assets in place are a huge advantage. They kind of allude to that here on significant barriers to enter. And then in terms of just the overview of the company, they own, this is a bit dated because it just said 238, or maybe they manage the other 30, but they own over 200 storage units. And just in terms of the value that they've created, the revenue, NOI, and AFFO in the last year alone is up about 25% across the board. So it really goes to show that this company's been expanding very quickly over the last 10 years, but it really hasn't been letting up at all, even in recent periods. They're still growing super quickly. And then in terms of the industry dynamic, this is an interesting real estate play, right? Because it's not like you have big tenants. You're really providing a direct to consumer, like a relationship directly with a consumer interaction in terms of like who's paying the rent. And the dollar amount that a consumer is paying, I don't think is very high. I don't own a storage locker or rent a storage locker, so I'm not sure. But I'd imagine it's like 60, 80, $90 a month. You're providing a service by storing stuff that they have nowhere else to put. So the switching cost is high. You're going to have to rent a U-Haul. You're going to have to move it somewhere else if you got a better deal to store it somewhere else or whatnot. So it's just one of those things like a gym membership that it's almost like a recurring revenue stream with the consumer. And then it's just not a lot of other options, historically almost non-existent in terms of competition. So they should probably be careful with how they're wording that as they keep trying to make more and more acquisitions, but it seems like it's the truth. And then from a rivalry standpoint, these markets are very local. So it's not a lot of people that are like, oh, I'm going to move my stuff from Toronto to Hamilton to save $20 a month. That just doesn't make sense. So typically it's a very attractive industry to play in. And then why they think this is going to continue to grow, just economic growth of the population. The average house size of people in large cities are going down as more people are moving into condos, apartments, and it's just not a lot of space to store stuff there. People are buying more stuff, holding more stuff, don't know what to do with it. And then this was a really interesting soundbite. The USA has an average of 8.3 square foot of storage space per capita versus an estimated 2.5 square feet per capita in Canada. So it's just not a lot of, it's an underdeveloped asset type in Canada versus the US, which is really interesting. So that's kind of the first growth stock we're going to talk about today, or that we're reviewing today. They continue to grow over 20%. They have forecasts to grow double digits as well. They've been doing that for the last number of years, and it may be priced into their stock a bit, especially with the run up here. But they've done a tremendous job at executing, expanding AFFO margin behind scale. So this is definitely a great Canadian growth stock to consider adding to your watch list. The second stock we're talking about today is goeasy. So goeasy is a alternative finance services company. Just making sure I got that right. And they provide different types of services. So I think of this company as like serving people who aren't able to get served by a big bank. So non-prime borrowers with Easy Financial would be their business unit that is for non-prime borrowers. So people wanting to, take a loan on their house or whatever it may be from a mortgage perspective. Easy Home, which is essentially lease to own goods and furniture. And then LendCare, which is a POS consumer financing option. So lots of different types of financing options. This company, similar to StorageVault, has exploded over the last 5 years, up 160%. You saw that run up even further during the pandemic. It's cut in half since then, but it literally ran like 500%. So definitely a company that's been a bit all over the place. But when we look at their results, they're just operationally trending in a great direction. So you can kind of see how fast they've grown this business. Easy Financial and Easy Home were kind of born in the early 2000s. By 2017, they expanded to Quebec. 2019, they hit their first billion in portfolio loans. And then just 2 years later in 2021, they hit $2 billion in portfolio loans. So that really goes to show they literally doubled their business in 2 years, which is insane. They keep building new and new products to bring in more revenue and more business that they really expanded out in 2020. And they just keep building and building every year that goes on. And that's where you'll get to some of the growth we're going to see on this next slide here. Just a bit of a summary. They serve through 1.3 million customers. They have 400 retail stores in Canada. Relatively new company, just 30 years in business. But their EPS growth rate is number 2 within the financial segment in Canada. So they definitely do have a good track record. You see their overall returns here. They're just kind of showboating a bit. But ultimately, they've really deserved that TSR. Look at their return on equity, over 22%. That's phenomenal. They've continued to increase the dividend every year too, which is really great. And then just from a growth CAGR, 18% top line growth, 29% bottom line growth, 25% EPS growth. So these numbers in any 1 year would be remarkable, but to see that compounded over a decade is truly unbelievable. I can't think of many other companies that have been as successful growing their business. So when we look at their stock price and we see it up 160%, oh, that's crazy. I'm not going to buy the company with it up so much. It's a different company. Their revenues are in such a different spot. They have compounded share growth of about 30% a year over the last 5-6 years, but their net income CAGR is about 30%. So the company's not any more expensive necessarily. They've really just earned that multiple from delivering more top line, more bottom line consistently at a strong growth rate. So this is definitely a fast growing Canadian stock. During a more recessionary time, this may not be a place you want a ton of exposure to, but nonetheless, they've really proven themselves over the last decade of really building the business effectively and continue to unlock growth levers on the business. So this is definitely one deserving to be on this list of top Canadian growth stocks. The third stock we're talking today is Cargojet. So Cargojet is a bit of a smaller company. Again, $1.9 billion company, currently trading, it says here, at a 12 price to earnings, paying a 1% dividend. Similar to some of the other stocks we're talking here today, Cargojet is up longer term, 66% over the last 5 years, but is down from their peak during COVID. So kind of a mixed bag depending on when you first bought the company, but operationally, they've continued to grow. So you see here, year over year, their revenue on the left-hand side has gone in from, 150 million in 2012, then under a decade, they're up here at almost 750 million. So they've 5x their business in 9 years. And I'm sure 2022, I think, was a decent year for them as well. And they've just shown the ability to continue to drive more business. By the way, Cargojet is a transportation company moving goods around the country. So their customers are like the companies you're seeing on the screen here. When you mail something through FedEx, UPS, an Amazon order, Canada Post, Cargojet's part of the logistical solution in how you're getting your product so quickly. And they operate a fleet of jets, or a fleet of airplanes rather, to help get stuff from coast to coast and stuff like that. So they've just continued to get new agreements. And what's really great to see is when they get agreements, they tend to extend them or expand them over time. So inaugural agreement with Purolator and Canada Post, and then it was renewed 3 to 4 years later, which means that they were obviously happy with it. Same thing with Amazon in 2019, 2021, it was renewed. And now they just got DHL as well in terms of an inaugural commitment. So that's a really good sign, really good momentum, because once you really lock in these big companies and you're providing them value, it's just a great recurring revenue stream to build off of, and you can try to sell them more and more services, provide them more benefits throughout their logistical chain. And that's really what Cargojet's done a good job of doing here. In terms of the routes and where they operate, you can kind of see exactly where they operate. So they do a lot of flights out of Hamilton, out of Toronto, or not so much out of Toronto, but more so out of Hamilton. That goes all over Canada, out east, out west. They have a lot going out of Vancouver too. They have some going up to the territories. That's probably a pretty rare flight. But overall, they're doing about 500 flights each week. So, what is that? Like 75 flights a day, give or take. So pretty big network for a company that was pretty small not too long ago. And then lastly, in terms of their cash generation, you can kind of see here their revenue in red. So even, I said they did 750 in 21, they grew significantly from that in 22 at $900 million. So really huge performance. But what's great to see is their EBITDA and cash flow is also trending up with that consistently. So they're running this business profitably, and they're running it sustainably, growing like significant growth for 1, 2, 3, 4, 5, 6, 7 straight years. So that's Cargojet. Definitely an interesting stock, in my opinion, to watch here, and one that I may be adding to my watch list. Going into the fourth company. The fourth company is Shopify. And I think I said top 5 companies. I really meant top 6 companies. I'll be throwing in a bonus one here for you guys. I lost count off the bat. But Shopify, most people probably know, is one of the largest companies in Canada, $81 billion company. You can see it over the last year, down 11% as tech's kind of got a bit hit in terms of valuation standpoint. But year to date, already up 33% just after one quarter. Obviously down from the highs, so pretty consistent theme with these growth companies that we're seeing here. But has started to bounce back. We're up like 60% from the lows in October. So Shopify is obviously an e-commerce company, helps companies with payment solutions and solutions to online storefronts, and they have a lot of different revenue streams that we'll go through. But they essentially, for the most part, just think about it as them taking subscription revenue from premium users, and then also taking a cut from how much people are paying on the stores, almost like a royalty off the top. In terms of their performance in 2022, and before getting into that, we'll just look at their market cap right now is 81 billion Canadian dollars. They did $5.6 billion in 2022 in revenue. That was up over 20%. So despite the stock going down a lot, the company's still having really strong growth, just maybe not as strong as before. They have a 10% market share in U.S. e-commerce in terms of the businesses that they fuel on the back end. And they have merchants in 175 countries, millions of merchants across 175 countries. One or a couple growth areas that they kind of have here, they're really going into bricks and mortars, point of sale a lot more. Think more like Square or Block, how they have those payment tablets. Shopify is breaking into that space. Still pretty small part of their business, but it's an area that they're focusing on, and they report on it here, showing that they actually grew the gross value of dollars that went through their POS systems by 40% in 2022. So that's a nice little flex that they're giving. They call out some companies. They look like they're relatively small companies, but I'm not sure. I may just not be in the know here. But Mom Spaghetti, Culture Kings, Todd Snyder, New York, etc. are using Shopify POS systems in stores. Another growth engine that they really talk about, and this is probably a bigger bet, is just expanding geographically all of their products. So Shopify Payments now in 22 countries, Shopify POS, which is what we just talked about, only in 14 countries, Shopify Shipping, 7 countries, Shopify Capital, where they loan money to small businesses, only in 4 countries. So obviously they have to do this right to make sure they're learning, and obviously there's local regulation, stuff like that. But over time, especially on businesses that should be cash cows once it's rolled out, like Shopify POS, and they're just having like a Visa or MasterCard like business model where they're getting a cut off the top, as they expand from 14 countries to closer to 175 countries that they have merchants in, there'll be a lot of just natural organic growth from that geographic presence that they could leverage. And then lastly, we've seen them have strong growth over time. We saw them have over 20% growth last year, but the outlook is also pretty strong from a growth standpoint. So the revenue for Q1, they think it's going to be in the high teens. So a couple percentage less than historically, but still really strong growth for a company like this. Margin expansion is going to slightly occur. Operating expense should grow low single digits, so their revenue is outpacing that. So overall, this is still a growth company. It's still a growth story, and that's great to see, especially on a company that's so big for the Canadian economy and the tech landscape in the country. Okay, going into stock number 5, it is Waste Connections. So Waste Connections is a garbage company. Year to date, they're up 10%. Over the last 1 year, 4%. Over the last 5 years, up almost 100%. So you can guess that they've been executing really well to get a 100% stock double essentially over the 5-year span. It's a big company, $37 billion company. Jumping into this one a bit. So some investment highlights they call out: they're the third largest solid waste company in North America. I think number one is Waste Management, which lots of people are probably familiar with. And another thing to call out here is they've grown a lot through M&A, and they have acquired and rolled up lots of assets from other companies within the waste management space. One thing that's unique about them is they focus on exclusivity in markets or secondary markets that are less competitive. So they're really looking for the profitable buckets of work within waste management to ensure that they're strong economically and able to deliver enough profits and cash flow to fuel their growth and their acquisition endeavors. So this is a much different strategy than like a waste management, for instance. Going on to their future growth, obviously they've had really strong growth the last 5 years. You saw it reflected in the stock price. But similar to Shopify, they're also expecting strong growth forward looking. So they're expecting 12% revenue growth for this year coming up, adjusted EBITDA of over 12% growth as well, and then margin expansion of 130 bips excluding commodity impact. So overall, they're still planning on being a business that's growing in double digits despite almost like a weakening economic time ahead. So this is definitely still a strong Canadian growth story that I wanted to flag here. And I think, is priced pretty highly right now, but I think operationally they'll continue to grow pretty nicely. And the sixth and final Canadian growth stock that we'll be talking today is Alimentation Couche. So this is a company that was originated in Quebec. They are essentially a world leader in convenience stores. They also own lots of gas stations that are attached to these convenience stores, some car washes attached. But they're really in that convenience store game. That's where they make lots of their profits. Some of their brands, you've probably heard of Circle K before. Max or Couche in Quebec is another one that you may still have in your neighborhood. Personally, in mine, they've changed them all over to Circle K. So that's probably something they're doing just to streamline the brand. And then Ingo is one of their European brands that they own, but that's just kind of the businesses they own. All gas stations, convenience stores, car washes attached to the convenience stores. This is a company that has really done a great job at rolling in acquisitions, driving scale, using free cash flow to grow internationally. And you can really get a good sense of that on this slide here, where just since 2001, this company, since 1980 to 1990, they just operated a store in Quebec. And since then, they've just exploded. 2001, made their first acquisition in the US. 2012, expanded into Europe. 2016, Ireland, and further into Canada. And you can kind of just see Asia, etc. So they're everywhere now. I'm not sure if I have a map here, but I've seen slides where it just shows everywhere they play, and they just cover essentially the whole world with different brands in this segment. So they really are a global leader. In terms of their growth, they've shown growth despite the economic climate, which is great to see. So they did fine during the dot-com bubble. They did fine during the Great Recession. That bodes well for if we have any issues in the near future with regards to their ability to get through it. This is another one just showing all the acquisitions that they've made over time. Just going to zoom in a tiny bit here. So you can get a sense, like Circle K was 2004, it looks like, and they've just exploded from there in terms of what they've bought. They've bought the convenience store assets of Esso, Shell, Premium 7, it looks like, a number of other gas stations, Fastmax, Super Pantry, some other businesses that had convenience store chains. Looks like last year in 2021, I wasn't aware of this, but they acquired an Asian line of convenience stores as well. So they've just done this 15, 20 times. They continue to look for growth through acquisitions. They tried buying a French grocer actually relatively recently, and I don't think that deal passed regulation. but they have been looking at other acquisitions in France. I think another one I have here is they just acquired the gas station and convenience store assets of a company in Europe. It was called Total Energy. They bought their physical retail footprint. So just had some details about that deal here as an example of what they're kind of doing to fuel growth. So this company operated in Germany and Benelux. I'm not sure how to say that. And the Netherlands, it looks like. And then they bought 60% of their business in Belgium and Luxembourg. So they have over 2,000 stores, over 1,000 of those are in Germany. And they are the number one market share in this space across Belgium, number two in Luxembourg, four in Germany and Netherlands. So pretty big business. They bought it at an 8 times EBITDA multiple, paid 3.1 billion euros. So that's probably, give or take, about the amount that this company makes on an annual basis. So they just took their earnings essentially from last year and accelerated the growth of their European operations by adding over 2,000 stores with 1 year of profit that they made on the business. And that's really the formula they've been using over the last decade to grow the amount of profit centers they have around the world. And lastly, similar to some of the other slides we saw here, just look at the total revenue story that exists here. So from 23 billion in 2012, over 10 years, they've got to 63 billion, almost tripled the business. They have a CAGR of 11% on top line, which is great, but you really start to see the scale flow through with gross profits growing 3% faster than revenues, EBITDA growing 6% faster than gross profits, and so on and so forth. So this company just has a great model of how they roll in acquisitions and how they create value through those acquisitions and through scale and purchasing and operations. And that's why they're a top Canadian growth stock and will continue to be over the next couple of years. So there you have it. Those are the top 6 Canadian growth stocks that I'm watching right now. If you like this type of content, be sure to subscribe to the channel, give this video a big thumbs up, and I'll see you guys in the next one.